Hello friends, today we will be talking about what is the uniqueness of monetary policy of Reserve Bank of India that was announced on 8th of April 2022. It is being announced at a very critical juncture when there is a geopolitical storm on one side, where there is a Ukraine and Russia armed conflict, there is a war that is going on one side, and on the other side central banks in many parts of the world are on the normalization track as far as the policies are concerned because of the rise in inflation. So as far as India is concerned, it is no different. We are also having the same kind of inflationary pressures because of the supply side disruptions that we were experiencing for the last about 2 years, and we have been recovering very fast from the pandemic shocks. In the meantime, there is the developments in the external sector have been very adverse. In this kind of situation, the monetary policy is very important, and many of the economists were expecting a rise in the interest rates. But compared to that, the Reserve Bank of India has always been innovative in its approach, and going forward, it has kept the interest rates intact, that is the repo rate at 4% and reverse repo rate at 3.35% and marginal standing facility at 4.25%. But at the same time, the stance of the policy has been slightly modified, that the Reserve Bank will be changing the stance depending upon how the inflationary trajectory will move, instead of adhering to the recovery from the pandemic. That was the earlier stance. So now, if the inflation goes up, the stance of the monetary policy may undergo a change. That's one of the biggest change that has been brought in this edition of the monetary policy. It has also recognized the various stress points in the economy and scaled down the outlook of GDP by 80 basis point and brought it down from 8% to 7.2% for the year FY23. At the same time, it has increased its outlook on the inflation and increased it by about 120 basis points and raised it from 4.5%, that was the earlier expectations of RBI for the FY23, but it has increased it to 5.7%. So that's one change that has been brought. Now, the other aspect is about management of liquidity. That is, Reserve Bank of India utilizes various tools to manage the liquidity in the system. All of us understand very well that because of the pandemic in the last 2 years, there has been a flush of liquidity into the markets because of the needs of the economy, and accordingly about 17.2 trillion of liquidity has been pumped into the economy at various points of time through various innovative tools. Now, when once normalization starts, it is incumbent on the part of the central bank to neutralize the excess liquidity in the system so that it does not hurt the inflation. Now, for this purpose, Reserve Bank has been utilizing variable rate reverse repo, that is VRR, since February 2021. It has started using, and it has absorbed a part of liquidity from the system to reduce the overhang of liquidity. But despite that, it is estimated that about 8.5 trillion of excess liquidity is in the system. Reserve Bank of India for the first time has invoked a distinct monetary tool, that is standing deposit facility, for the first time, and fixed a rate of 3.75%, where banks can place their deposits, that is the Reserve Bank can suck excess liquidity at 3.75, that is the floor rate of liquidity. And marginal standing facility has a rate of interest of 4.25%. The difference between the two brings the corridor of liquidity down to 50 basis point, which is pre-pandemic level, which was increased during the pandemic period. Now, with the introduction of standing deposit facility, Reserve Bank need not in exchange provide government securities to the banks. It can suck liquidity without issuing government securities, and it can absorb liquidity for overnight or for a longer period depending upon the need. So, the uniqueness of the current edition of monetary policy is the invocation of the tool of standing deposit facility, which has been recommended by the Urjit Patel Committee way back in 2014. It is only in 2018 that the RBI Act has been amended to bring it into force, and now RBI has invoked that particular tool. So, that adds another tool in the armory of Reserve Bank of India as far as management of a liquidity adjustment facility. Now, in this kind of situation, a couple of things are very, very clear, that there is a lot of stress in the economy because of the external factors, and the good thing is we have done very well in terms of our export performance, and there are stress points as far as our current account deficit is concerned, which is 2.7%. As far as December quarter is concerned, it is poised to go up as the bill of imports go up and the price of crude oil goes up, which has gone as high as 130 per barrel, but it has now been moderated to 113 last known figure as far as the cost of 1 barrel of crude oil is concerned. So, it is going to impact the inflationary trajectory in India. If inflation goes up, automatically the stance of the monetary policy can undergo a change, and maybe in the coming quarters what we can expect is a little hike in the policy rates if there is a need. Now, in addition to these measures, Reserve Bank of India has also introduced regulatory dispensation that the relaxations which have been given for the housing loans, that is rationalization of the risk weights in according to the LTV, that is loan to value ratio, has been extended from March 2022 to March 2023, so that the flow of credit to home loans will not be disrupted, and there will be lot of encouragement for doing so. And it has also mandated the banks to go ahead for introduction of cardless facility as far as the cash withdrawal at the ATMs are concerned. So, maybe that going forward very shortly we will be able to withdraw money from the ATMs without using our ATM cards with the help of UPI app. So, a lot of developments are going to take place, and in a critical situation RBI has come out with innovative tools for the purpose of absorbing the liquidity, and at the same time it has given a very transparent dispensation to the markets that they can prepare themselves to operate in the emerging environment. So, these are all some of the very interesting points as far as the monetary policy is concerned, and going forward we will be discussing more about the kind of policies that are going to be rolled out. So, thank you very much for watching this, and please do not forget to subscribe, to share, and leave your comments in the comment box so that we can exchange our views and keep our learning going forward. Thank you so much.